Finance Minister Bill Morneau is proposing new tax rules for high-income earners. The proposed rules aim to close loopholes often used by wealthy Canadians to reduce their tax burden. Our next guest says more taxes from the government could create more incentive for people to cheat or evade them. For more on this announcement and what it might mean for Canadians, we're now joined by David Rotfleisch, founder and senior tax lawyer with Rotfleisch and Samulovich. Good to be with you today, David. Thanks for coming in.
My pleasure. Good to be here.
Let me first have you explain exactly what they're proposing. Let's start there.
Okay. There are three distinct proposals. The first one, and the one they've actually released 28 pages of draft legislation on, involves what's called income sprinkling. The concept of income sprinkling is transferring money from one income earner to a spouse and kids. And the purpose of doing that is to reduce the overall tax burden caused by progressive tax rates, which mean the more money you earn, the higher the rate of tax, not just the amount of tax that you pay.
Okay.
So that's proposal one. Proposal two, which I don't really entirely understand, discusses the concept of passive income in corporations, and they don't want the passive income to accumulate in corporations, to pay tax at lower rates in corporations. Now, at present, there is an integrated system, so you pay the same rate of tax on passive, which is investment income or rental income earned in a corporation versus if you earned it directly. So I really don't understand what this rule is about. I understand the concept behind it, but as far as I'm concerned, based on what I've seen so far, it doesn't really make sense. The third rule deals with capital gains. And what they want to do is to prevent people from shifting what would otherwise be high rate income, which is income from salary or to some extent dividends, into capital gains, converting it to capital gains, because capital gains, as you may know, are taxed at half rates. So there are a whole host of rules right now designed to prevent this, and this looks more like housekeeping. They're trying to close some loopholes, because there's always planners who come up with new rules every time the Income Tax Act gets amended. Then the planners come out and we come up with new ways of getting around the rules. So that's a cat and mouse game that's always played.
Okay, but is this different in any way? I mean, you say they're trying to tighten it up, but when you just talk about everything that they're going through, they're essentially going after the individual, they're going after the corporation as well, and they're going after investment income in terms of tightening up. That's pretty much everything. Just the other day I was reading that Ontario, as an example, actually has the highest tax in all of North America, if that's possible.
Yeah, we're at 54%, almost 53 and change marginal tax rate, which means the government is a senior partner in your paycheck. And if you remember the old Beatles song, The Tax Man, that was all about the UK taxing at 80%, which is even more outrageous. But any time the government becomes a senior partner and takes more home than you do, people really have an incentive to legally reduce taxes, or in some cases, in a lot of cases, to illegally reduce taxes through tax evasion. It's a problem when tax rates get too high.
What would be a way for anybody to legally circumvent this?
Well, until we see what the new rules are, we don't know. But there's a huge tax planning industry out there. I mean, there are a relatively small number of Department of Finance officials drafting this legislation, and they're certainly smart people. But when you put the combined brain talent of the entire tax planning industry, there will be loopholes that we come up with. So, for example, the capital gains rules have been around for a long time. They keep tinkering with them, tightening them up, and we keep coming up with new ways to try to convert income to capital gains. Now, you may say from an equity point of view, it's unfair. That's the government says, and they may be right, but my job as a tax lawyer is to serve the interests of my client. If you're my client, you're coming to me and say, how do I reduce my taxes? And I'm going to tell you what we can legally do to reduce your taxes. So that's what I have to do, and that's what the system is. So the government will tighten it. We'll come up with new ways of getting around it.
And there will be new ways to get around it. That's interesting to me, because I just feel as though they, as you say, they're closing in, they're tightening more and more. Essentially, they just want to get more money or become an even more senior partner in your paycheck.
Of course. But I don't know if you've actually seen the Income Tax Act. I imagine you haven't.
I have not.
It's this thick, in very thin paper, very, very small fonts. It is thicker than a phone book. It is so mind-bogglingly complex that it's impossible for anyone to really close all loopholes.
Okay.
Because there are competing policies in the Income Tax Act. You're trying to do this, trying to do that. I mean, you legitimately want small businesses to be able to sell, or small business owners to be able to sell their shares and not pay a certain amount of capital gains. So you have that provision available. So if you come to me and say, I've got a business, I'm planning to sell at some point, I'm retiring, we'll do some estate planning. We'll get your spouse involved. Your spouse will be a shareholder. And then when it comes time to sell, you'll both get the capital gains exemption. If you have adult kids, maybe we can get the kids involved. Now, this is legitimate, from my point of view, legitimate tax planning. Makes a lot of sense. If you're my client, this is what you want to do.
Yeah.
Government point of view, well, I'm giving $800,000 and change of capital gains exemption right now. I don't want to double that to $1.6 million. I just want you to be able to claim it, not your spouse. So there'll be a cat and mouse game. Potentially, if they're closing this, and there's potentially they may be closing it. I'm not sure.
David, when will we find out about this?
Well, we have the 28 pages of rules about the income sprinkling. What they're doing is they're amending 120.4, which is what's called a kiddie tax section. Mind-bogglingly complex again, a very, very complicated section. So we're going to have to work through those rules. The other two proposals dealing with the passive income, which again I don't understand, and capital gains are open for consultation period. So they're going to take consultations from the public, and then we'll see what the amendments are going to be.
David, you mentioned how large the Tax Act here is in Canada. We know that's the case in the United States as well.
Yes.
But you mentioned to me during the commercial break that it seems though they might have it even a little bit better than we do. Well,
what I was specifically referring to is the concept of income sprinkling, where you transfer money specifically from spouse A to spouse B, is because we have a progressive rate of tax, which means that the more you earn, the higher your rate of tax, not just the amount of tax you pay. In the U.S., they have joint tax returns. So husband and wife file one tax return, and the income is averaged out at whatever those rates are. So they don't have that incentive or need to do income splitting between spouses. You still can with children, but it's different. Here, there's a strong incentive to income split with a spouse.
David, as an expert in your industry, what would be your message to the government as it relates to these potential changes? Well,
the message that the industry has been giving for 30, 40 years is simplify. But we're also into policy decisions. I mean, the Liberal government has a very distinct policy decision that they want to increase taxation on wealthy Canadians and reduce it for the middle class, which is what they've done. And this is part of that philosophy. Now, whether you agree with that philosophy or not, that's a matter for governments. You don't like it, you have to change governments.
Right.
But my personal point of view is that a tax rate of over 50% is too high, and that some of these rules are not necessarily fair.
Understood. David, great to be with you today. Thanks so much for joining us.
My pleasure to be here.
Appreciate it. Thank you.